Welcome to this video on risks to our 2025 outlook. 4 weeks ago we published our outlook for 2025. Today I analyze whether things could turn out differently. I start with the question of whether the Fed might raise its policy rates next year rather than lowering them as widely expected. After all, inflation would rise by a full percentage points even if Trump were to implement only half of the announced tariff increases. One argument against interest rate hikes is that this would put the Fed in open conflict with the new President Trump, which would be bad for its reputation. In the Eurozone, the Purchasing Managers' Index has recently slipped into recession territory. In this respect, a contraction of the Eurozone economy in the winter half year cannot be completely ruled out. However, the fact that the headwind from monetary policy has recently eased considerably speaks against this recession scenario. On the one hand, many companies have become accustomed to the interest rate hikes of 22-23. On the other hand, the significant rate cuts of the ECB and other central banks should have a positive impact on economic activity. This suggests a moderate recovery in the Eurozone economy from the spring onwards. In the Eurozone, consumer prices, excluding energy and food, have risen only slightly in recent months. Some central bankers are already warning that the ECB's inflation target is being undershot. In fact, core inflation is likely to fall towards the 2% target of the ECB in the course of next year, mainly due to the weak economy and the indirect impact of the fall in oil prices. However, the continued strong growth in wages speaks against a meaningful undershooting of inflation. Turning to the high government debt in many developed countries, there are concerns about possible market turbulences like the one we saw in the UK market in 2022. For example, the US federal debt relative to GDP will soon be as high as it was at the end of the Second World War. In France, the sovereign debt ratio is already above 100% of GDP. As far as the US is concerned, it continues to benefit from its status as the world's reserve currency with no alternatives in sight in form of the renminbi or the euro. This argues against bondholders becoming nervous next year. With regard to the Eurozone, we have been emphasizing for years that the root causes of the sovereign debt crisis have not been resolved. On the other hand, the ECB is building up a deeply layered defense system against a resurgence of market turbulences. In this respect, investors are likely to continue to price in higher risks of French government bonds, for example, in an orderly manner next year.